Good morning, everyone. My name is Mark Stansfield and I manage the analytics team here at CoStar. And I'm going to spend the next 15 minutes reviewing the latest market trends, drawing on CoStar's live database of more than 500,000 commercial properties across the UK. I'll also review our latest forecasts. I'll start with a look at the economy and then move on to look at office, retail and industrial in turn. And there's a lot to cover, and I'm going to whip through things pretty quickly. So brace yourselves for a blizzard of charts and information, all tied together by this dull, energy-sapping voice. First, the economy, and the good news is that UK GDP grew by a record 15.5% in Q3, following Q2's record 20% drop. But momentum slowed during the quarter, and the economy remains 8% smaller than in February, while renewed restrictions should lead to another contraction in Q4. Lockdown measures led Oxford Economics to revise down its GDP forecasts in mid-November. The firm now expects an 11.3% drop this year and a more modest 5.2% rebound in 2021. Very much a U-shaped recovery then, rather than the V-shaped one previously hoped for. So that sets the context. Now let's dive into what our real estate data shows. Starting with office. And the first thing to say is that UK office landlords came into this crisis in a strong position. The national vacancy rate was below 5% in March, its lowest level in well over a decade, with nearly all major markets enjoying vacancy rates comfortably below long-term averages and with a relatively modest speculative development pipeline. Demand was healthy and rents were growing. But what trends have emerged since the crisis began? Well, new leasing has of course slowed markedly, with take-up in Q3 only marginally up on Q2 and down 60% compared to the same period last year. Leasing hasn't historically slowed to this extent during economic downturns, as lease expiry dates occur regardless of the economic climate. Anecdotally, it appears landlords are accommodating many tenants with short-term extensions until they gain a better idea of financial performance and space needs. The market has not dried up completely though. CoStar's recorded 3,000 office lettings since the pandemic began, with this map showing those over 25,000 square feet, some of whose tenants I've highlighted. The largest was by the Home Office down in Croydon, with the public sector accounting for an outsized share of leasing during the crisis. Bailey Gifford signed the largest private sector letting up in Edinburgh, pre-letting 280,000 square feet at Haymarket, while the likes of Cadent in Coventry and Aviva in Glasgow have supported a growing share of out-of-town leasing post-pandemic. More space has been placed onto the market than leased, however, and overall availability has risen. This rise has been greater in London than in the regions, Midlands included, with London's availability rate now above the regional availability rate for the first time in over a decade. Part of that is a sublease story, as firms look to offload surplus space, a trend that's been far more prevalent in London than elsewhere. London's availability rate has jumped by 35% since March to stand at a 15-year high. Meanwhile, sublease availability in the regions has barely changed. Differing availability trends have been a factor in relative rent performance. Rents are holding up better in the regions than in London, with asking rents in the capital now falling. We've also spotted some interesting trends by building size in our data. Rents are falling in smaller sub-15,000 square foot buildings, but holding firm in larger buildings, which partly reflects more resilient demand in larger, more socially distance-friendly properties, as well as a greater reluctance of larger landlords to chip asking rents. On the investment side, investors have focused on prime well-let assets. All the deals shown here in London, Birmingham and Coventry fit into this category, with limited demand for value-add or development sales in the current risk-averse climate. The circa £380 million price paid for London's Cabot building was around the same price at which it was under offer to Blackstone just before the pandemic struck, with the Colmore Road price 7% above its 2018 sale price. Increasing evidence of pre-pandemic pricing is persuading more owners of prime property to market their assets, with several big deals concluding in October. A disconnect has therefore emerged between a fairly quiet leasing market and an increasingly active investment market. So what's the overall outlook for vacancy, rent and price? Well, CoStar's forecast for supply, demand and vacancy has the national vacancy rate increasing over the next few years in line with rise in supply, although the furloughing scheme, reduced office density and the relatively strong rebound in jobs means any increase should be gradual, with vacancies remaining fairly low throughout the forecast. The vacancy rate outlook varies by geography. London, which accounts for more than half of office construction underway nationally, is projected to see a greater increase in vacancy than the rest of the UK in the coming years, especially the Midlands, which will see barely any rise in vacancy at all. The baseline UK vacancy forecast results in a fairly benign rent outlook. Rents are expected to fall over the next 18 months, but only by around 3% or so, before flattening off and ending the forecast a little above current levels. However, CoStar offers a range of different scenarios, and in our worst case depression scenario, where the pandemic remains uncontained for an extended period and leads to widespread economic turmoil, unemployment jumps up and net absorption turns sharply negative. The national vacancy rate jumps to around 9% and doesn't peak until 2022. However, even in this gloomy scenario, vacancies would only return to levels last seen in 2013. Rent losses would of course be much steeper in this scenario, with average rents falling by more than 30% over the next 2 years and not returning to current levels for the remainder of the forecast. On the pricing side, our baseline forecast calls for office prices to drop by about 8% over the next couple of years, before recovering from late 2022. However, as I mentioned, there are a range of potential outcomes here at a national and local level, and you can see the national range in grey on the screen, which is a screenshot from the CoStar product. Incidentally, we join all our clients in hoping that the more optimistic forecast comes apart. Moving on to retail now, a sector that was already struggling before the crisis. There are many themes I could touch on, but I'll just mention a few. Firstly, Google's mobility data shows the effects of lockdowns and working from home on footfall. Before the second English national lockdown, foot traffic in Birmingham had recovered to about 70% of its normal levels, a much higher figure than in London. But with only essential retail allowed to open currently, footfall has fallen away. Declines in footfall, along with a multitude of other factors, have understandably hit demand for retail space. The pool of national retailers looking to expand has thinned in recent years, and even more so since the pandemic began. Whilst discount and value stores are still acquisitive, store expansion programs by a select few retailers are insufficient to offset the amount of store closures by other retailers, many of which are entering administration or CVAs. We've recorded more closures than openings across the UK, but the picture does vary by region. Our lease comps and availability data suggest that for every new retail letting recorded in the Midlands, 2 shops will put up for lease. While net negative, this is a far better performance than many other regions, especially the North East. Weak demand overall is likely to accelerate the trend of retail conversions. Amazon recently bought a former Toys R Us in Croydon and a retail park in Mill Hill for conversion to last mile. The Westfield House of Fraser will be largely converted to offices, and British Land just announced plans to repurpose vast swathes of its retail portfolio. This will be a persistent theme in the coming years, especially given recent planning changes announced by the government. And there are segments within the sector that have done very well throughout the crisis, notably supermarkets, where pricings remained resilient amid continued investor demand. In addition, the £320 million sale of the Chanel store on Bond Street suggests persistent demand at the super prime end of the market. Moving on to industrial now, a sector that's largely benefited from retail struggles and where demand has remained resilient during the crisis, especially at the big box end of the market, with 2020 very much the year of the mega shed. Leasing is up 30% in this larger segment, as firms from a range of sectors boost their logistics footprint to service growing online retail demand. Amazon has been a big part of this, of course. This map shows the sites it has taken this year, ranging from 50,000 square foot last mile units to 2 million square foot mega sheds, as it continues to take advantage of the online shopping boom. Most markets have seen strong demand, but this has been led by two markets in the Midlands, as you can see by our analytics tool that ranks the 55 UK industrial markets across different metrics. This one showing a ranking of annual net absorption. Coventry, Birmingham and Northampton also feature in the top 12 by this metric. Robust demand has seen the national industrial vacancy rate fall to record lows in recent years, and it's expected to remain low in the coming years, as shown by the orange line. This should fuel further rent gains as industrial continues to outperform other sectors, albeit after a slowdown next year. Investors understandably have piled in, especially into urban logistics. Blackstone has been active as part of its Mileway joint venture, closing a host of deals since March. Meyer Bergman has launched a €2 billion fund targeting urban logistics across Europe, while Segro is targeting further acquisitions. Lots of demand for industrial property. And this has been reflected in pricing, which we can see by looking at REIT prices since the pandemic began. Industrial is the only sector where share prices have risen, while retail-focused REITs in blue have seen their values plummet, with offices somewhere in between. So to summarise, office leasing has slowed sharply, with vacancy rising from low levels. London and smaller buildings have been hit hardest so far. Office rents to fall by 3% and prices by 8% in the base case. Retail's in distress, but the crisis is just accelerating change. Industrial's resilient, and investors are piling into last mile. But the picture is nuanced, and access to accurate, meaningful, comprehensive and timely data has never been more important. And on that note, a wealth of market reports, nearly 3,000 in fact, can be accessed in the CoStar platform, all with forecast, most with commentary. You can also access thousands of up-to-the-minute charts and forecasts of any bespoke set of properties in the database. And it's not just reports, we have a wealth of market videos and webinars too, 70 in fact, since the crisis began. Why not grab some popcorn and a pina colada and make a Saturday night of it? And with that, thanks very much for listening and enjoy the rest of the conference.